You're listening to Choose FI Radio. The blueprint for financial independence lives here. If you're looking to unlock the secrets to financial independence and early retirement, you're in the right place. Stay tuned and join a community of like-minded people who are getting off the hamster wheel and taking control of their lives in the pursuit of financial independence. Choose FI, your home for financial independence online.
Everyone, super excited to dive into this week's episode. We are finally getting the opportunity to speak with Paul Merriman. And I say that because this is an episode that is by popular demand. Our community, you, have been asking us for over the past year to reach out to him and have him on the show and do multiple things. One, just explore his backstory, which is incredibly fascinating. But two, help us do a little bit of compare and contrast with the simple path to wealth versus the ultimate buy and hold portfolio. This is going to be a fascinating conversation. I think it's going to be such a value add for our community. And to help me with this, I have my co-host Brad here with me today. How you doing, buddy?
Hey, Jonathan, I'm doing quite well. And yeah, it's a rare opportunity that you get to speak to someone who's considered a legend in this world. I mean, we have basically, as I see it, three main investing strategies that we've talked about roughly in passing. I mean, obviously, J.L. Collins' Simple Path to Wealth, John Bogle and the Bogleheads, and I guess the three fund strategy, and then the ultimate buy and hold strategy by Paul Merriman. And we've luckily had J.L. Collins on, and now we get to have Paul here. So this is really, really exciting. And with that, Paul, welcome to the podcast.
Hey, it is great to be here. You guys are doing a great job.
Well, thank you so much, Paul. And this has been a real treat. I mean, we've been looking forward to this and preparing for this for a while just because there's so much information to cover today. But before we go into, the tactical stuff, I want to back up and really talk a little bit about your backstory because you have the consummate FI story. And I believe that it starts in the 1960s with your stint in Wall Street.
Yeah, I started as a stockbroker, and I did that for about 2.5 years. And I saw the writing on the wall, the conflicts of interest, the boss telling you what to do, what to sell, when to sell it. And I had to leave. I just couldn't take all those conflicts of interest and did lots of different things between the about 69 through 83. At one point, I ran a public corporation and kind of retired at age 40. And I said, I'm going to do something now that I just love to do, and a hobby in a way. So I started my investment advisory firm with no money under management and started teaching, and finally attracted a group of people that wanted my help. And I built what turned out to be a very successful investment advisory firm with the help of a lot of people, because I am not a financial planner and I'm not a security analyst. I am a guy that has been around the investment community now for literally all of my adult life. And I love teaching people how to do this on their own.
So Paul, help me out here. I'm so curious about this. You retired at age 40, but then you had this entire second career or second life as a teacher. How does that fit into your life's journey and your view of yourself, really?
Well, I didn't have to work, I thought. I mean, I'm a workaholic, so I had to work, to be fair. But I didn't have to work for anybody else, again, at least that was my assumption. And so I opened the door to being an investment advisor. Nobody knew me as an investment advisor. And I required a client with a lot of money. My minimum size account was $2,000. And so I would work for you for a year for 1% or $20, and I would be your advisor. And from there, we built a firm that had about $1.6 billion under management when I retired in 2012.
Can we talk about your business model just for a second? Because I believe when you actually set that up, at some point you were doing, or you did, I guess, an accumulation, thousands of workshops all across the country. Like, how did that actually pan out for your business model?
Well, in certain areas, it worked beautifully. And in a lot of cases, I ended up teaching do-it-yourselfers how to simply be a better do-it-yourselfer. But the idea was show people exactly what to do on their own. They didn't need to hire us to do it for them. Then after they sit through one of my 3 to 6 hour free workshops, I offered them a free consultation. I didn't care if they had any money at all. I was kind of retired, so I was just having a good time. And so I would sit with them for probably an hour to an hour and a half, and I would tell them what I think they should do with their money. And if they didn't want to do it themselves, our firm was willing to do it for them. So that's how we built our business. What I liked about it as a business model is it eliminated the conflict of interest that you have when the only answer at the end of the sales pitch is you have to do business with me. I took the approach, let me show you how to do it on your own. Now I'm retired, and all the work I do is for people who are doing it on their own.
You know, as a fan of your podcast, Sound Investing, I can personally say that you have the heart of a teacher. It comes through so clearly, and I can only imagine that in these workshops that you're giving, it did as well. My question to you was twofold, and we'll start with the more obvious one. In a 3-hour workshop, you're essentially coming in saying, I'm going to teach the DIY investor what they need to learn. What bullet points did you cover? What are the big keynotes that these individuals that were coming in for 3 hours or coming in for 6 hours, what was the skill set that you were passing along to them over that period of time, just at a macro level?
Well, I think the first thing that you need to be able to do is to make sure they do understand the investing process. I look at it like this. We have to figure out who we can trust. And if we can figure out the right person or organization or group of people, whatever it might be, that we can trust, then we can move forward to apply that information that they've handed us. And what do we choose from normally? We choose from Wall Street as the source of information, or we choose from Main Street, our friends and neighbors, or we can look to the academic community, what I call University Street. As far as I'm concerned, the only one that I can trust to bring the information to you is University Street, because Wall Street just doesn't have a very good reputation for honesty. And Main Street, our next door neighbor, obviously we really don't know how much they know. In fact, normally they don't understand investing, and yet they courageously pass it on to others and sometimes cause them a lot of losses they didn't have to suffer. So I start there. And then to the extent that I say, okay, what does University Street, what do the academics say about investing? And piece by piece, if you look at what they tell us you should do, it's very simple as long as we never have to make more than one decision at a time. Buy and hold versus timing, load versus no load, mutual funds versus individual stocks. If we can boil everything down to these simple forks in the road, it's pretty easy to teach people how to be a successful investor, but offer them 100 things they have to do at one time, and their brain can't handle it. So I can break it down pretty easily. And anybody, once they understand these very simple forks in the road, they can handle it. It is being loaded with a whole bunch of decisions at one time that we're not built to handle.
So, Paul, you talk about these high-level decisions, and I'd love to hear like your general advice, if you don't mind. So you talked about buy and hold versus timing, no load versus load, mutual funds versus stocks. Like, what is your ultra high-level advice for a successful investing life or career, whatever you want to call it?
Yes, let's try to compress 6 hours down into 5 minutes. What do you got? Go.
Hey, bullet point. Come on.
Well, the first thing that people need to understand is they need to understand who they are, where they need to go. That has, in many ways, very little to do with dealing with all those forks in the road. Because if you don't understand yourself, as you guys know, the emotional hurdles of investing those are the things that get us in trouble. Investing has never been easier. It's never been cheaper. It's never been more diversified. It's never been built. The products themselves are so simple today and so inexpensive that that part is not the problem. The problem is figuring out, can I buy and hold? Because if you won't buy and hold, then you're probably not going to be a successful investor. But if you don't think you can buy and hold, what if we figured out how much risk you'd be willing to take without throwing in the towel? Because if we can find that combination of an investment that will give a decent rate of return and within your risk tolerance, maybe you could turn yourself from what I call an ICSIA market timer, I can't stand it anymore, into a legitimate buy and holder who will be able to stay the course, because all this information is valueless if you as the investor can't stay the course. So that my goal then is, if you could understand yourself, let's look at the equity asset classes, the stock classes. I don't care about individual mutual funds. That's not what makes you money. It's having your money in a particular asset class, stocks versus bonds. What would I have to say to you as a potential investor to convince you, and let's say young investor, that the better decision is stocks over bonds? Well, what if I showed you a table, numbers? I just love numbers because they are the best storytellers that I know. And what if I showed you a table that showed that over the last 91 years, that intermediate term government bonds, that $100 grew to about $9,000. But then I show you another table that shows you that $100 in the S&P 500 grew to $460,000. If you really care about your financial future, would you be trying to figure out, well, okay, how can I have some of that in my portfolio? And then my goal is to try to show you the lowest cost with the most diversification. I mean, these are not complex topics at all. So my hope is, and every time we come to a fork in the road, that we can keep it so simple that you know which box to check. I teach college kids. I help them figure out which box to check.
Yeah, Paul, that's fascinating. And I just want to kind of go back for one quick second to the psychology of this. So you said there to stay the course and to understand yourself. And I'm curious, how did you counsel your clients? Because, I mean, you said you had $1.6 billion under management. So, I mean, tens upon tens of thousands of clients, presumably. How do you counsel them not to freak out and sell when the market is plummeting? And how do they overcome those psychological issues, really, when there's so much fear and they see their equity balances plummeting?
Well, there's not a simple answer for this, because this is the challenge for do-it-yourself investors. Everybody comes to the table with a different set of experiences, things they believe, things they've heard, things they want, things they're afraid of. And so for myself as a teacher, I struggle with, how can I convince a person who is an amateur just getting started that they can stay the course and that's the right thing to do? Well, there are some lessons, and they're powerful lessons. I don't know if they work, but let me give you one of those lessons. From 1929 to 1938, if you invested in small cap value, a type of stock, an asset class, and an asset class that has a long history of good returns. But what happened from 1929 to 1938, if you invested $1,000 in 1929, by the end of 1938, it was down to, I think, about $400. Well, that's catastrophic. I mean, you're trying to retire at a young age in many cases, and the first thing that happens to you out of the gate is that you lose over half of your money after 10 years. But what happened to the investor that dollar cost average. Put in money every month, or let's just think in terms of, because we're talking about $1,000. Let's say you put in $100 a year over that same 10-year period. Instead of ending up with $400, you end up with $1,600. You had over a 10% compound rate of return in the worst 10 years in stock market history. What I hope it teaches is that for the young people, I'm trying desperately to start investing young and to actually celebrate a bear market. There is nothing better than being able to buy some great asset classes at a lower price. That's a benefit, not a penalty. It's our parents and our grandparents that may be sucking gas and not feeling good about having the market down. But we who are dollar cost averaging in to great asset classes, never an individual stock, because you could lose everything that way. Think Enron. But these combinations, these diversified, massively diversified portfolios, it's a piece of cake. You've eliminated the risk of a stock going out of business. And you've taken advantage of the greatest thing that has ever happened to an investor, buying and owning great companies at low prices. So celebrate. Don't be afraid.
I love that mindset. You summarized it perfectly. I actually want to dive a little bit farther just because you talked about asset classes and you specifically mentioned small cap. And when we started, we just kind of talked about stocks versus bonds. But really, we're going into a subsection here and we're actually describing, I think it's going to be very useful for our audience to actually understand small cap versus large cap versus value versus growth for a person that ultimately just wants to own good companies over long periods of time. How do we break this down? What does this really mean?
Well, you used a great term there, I think, and it probably does represent how a lot of people feel. You said they want to own good companies or maybe even great companies over a long period of time. Well, here's the fascinating research. Again, going back to the numbers. If we go back 91 years, the companies that give as a group, never one at a time, but as a group, the ones that have actually got some problems, not the best companies, but what they call the value out of favor companies. And the academics have a way of identifying those companies that obviously people don't want to own because they've priced them not to own them. But what the academics discovered is that the group of companies that are out of favor are the ones that over time have the best return. And then, of course, there are smaller companies. And remember, that better return doesn't come because of greatness. It becomes because you took more risk. Smaller companies are more risky as well. So if you buy 5,000 small companies, you're going to have some jewels in there, and at least that's what history shows. But those small companies are much riskier than the very large, well-known, great companies that we think we want to own. So you get the premium. You get the premium for small, and you get the premium for these out-of-favor companies. And then, when you're young and you can take the risk, you put together small with out-of-favor, and that is the most profitable asset class for the long term, but it's because it's also risky.
And Paul, when you're talking out of favor, would that be value? Is that quote unquote value? What, I guess, define value and growth for the audience.
Well, the value, the way the academics say that you can identify a group of value companies, you would buy those companies that have a relatively high book value, the real net worth of that company versus their market price. On the other hand, there are companies, growth companies, that have very high, what they call price to earnings ratio, or high, they're priced way, way higher than their book value because people want to participate in this amazing future. Think Google. I mean, the companies that have made tons of money over the last decade. What is so interesting is how many of those companies in the long term don't do so well, and how many of those companies that were out of favor come back to do well. This is the capitalistic system. When there is an opportunity for people to make money on something, they're going to try to make money. And that's what happens to a lot of value companies. They get turned around and have great futures. And a lot of those popular growth companies that everybody wanted to be part of, all of a sudden are not so attractive. And when for some reason they're not so attractive because they're priced at such very high prices, they can fall like a rock. And I'm not saying don't own those great growth companies, but I want to own the growth and I want to own the value. I want to own the large, and we're talking about companies $50 to $100 billion, and I want to own the small. We're talking about companies that are $2, $3, $4 billion.
Paul, since we're defining terms, I want to talk about the makeup of, let's say, a mutual fund. I think a lot of people, especially in our community, are wary of stock picking or like any type of active management. And even just kind of reflecting on something like VTSAX, the Vanguard Total Stock Market Index Fund, it's cap weighted, right? And that was a decision made. And I guess, a significant amount of that total stock market index fund is made up of the top, let's say 50 or 100 companies. So that was a decision. And I'm also curious, I guess, A, your thoughts on that, but B, how a, let's say, small cap mutual fund or ETF, how that is made up. Is it also cap weighted, or like what have you seen and what do you advise people look for?
Well, you've got a whole bunch of questions in there. So
I thought so too. Very ambitious, Brad.
I've got a free ebook entitled 101 Investment Decisions Guaranteed to Change Your Financial Future. Now, I'm the first one to admit that I can't guarantee whether your returns will be better or worse, but I guarantee they'll be different. The idea is, of course, to find the fork that takes you to a better return. So let's talk about this fork in the road that I think is life-changing. If you take active management, what does the evidence show? Now, what is the active manager trying to do? They're trying to beat the market. If they can't beat the market, whatever the market might be, small or large or value or growth, if they can't beat the market, why would we pay them a fancy price to give the result of an index fund where you get the market? So what do? Well, they try to find better stocks. They try to get in them at a good price and out at a good price. And maybe they'll try to market time and protect your portfolio against a big decline in the stock market in general, called market timing. So there's stock picking and there's market timing. And if they're doing this well, then maybe they could theoretically beat the market, which would be great if you made more money. I mean, 0.5% is a life changer over a lifetime. If you could just find an extra 0.5%. So along comes the index fund, where they've got maybe 500, maybe they've got 5,000 different companies in the portfolio. And they aren't trying to beat the market, they're trying to be the market. So what do we know about their performance? Well, we got the numbers, and the numbers are wonderful because the S&P, Standard & Poor's, puts out every 6 months the SPIVA, SPIVA report, and the SPIVA report tracks the returns over longer periods of time of active managers and passive indexes, the benchmark. And what do they know? Well, the bottom line is, if we look over the last 15 years from the latest report, about 3% of the small cap managers are able to beat the index. About 5% of the mid cap and about 7% of the large cap are able to beat the benchmark. So here I am trying to decide, okay, do I think I have the ability to pick an actively managed fund that is going to beat the index when only about 1 out of 10 or 1 out of 20. Gosh, if I went to Las Vegas and decided to bet like that, I'd be broke in no time. And so if I can be the market and be assured I'm going to be, in essence, over the long term, and I'm talking 15 years is how far out they go with that particular study. If I can be in that top 5 or 10%, will that be enough? I met with John Bogle in June of 2017. He was kind enough to let me fly back to Pennsylvania, and I spent 90 minutes in his office with him. And he really, in fact, he's got a book called Enough. And if you can figure out what enough is, and it turns out that the return of the benchmark or these indexes is going to represent enough. And by the way, remember, the other people who were trying to beat them are mostly making less than enough, if that's enough. And why would we pick the odds of probably ending up with less than enough when we can get enough and not have to worry about it? And in fact, when you bring this question up about how can we find peace of mind as an investor, well, what if we have a portfolio that's made up of thousands and thousands of stocks? Do we have to worry about what happens to Enron? No, we don't have to. And I've given up worrying about Eastern Airlines. They went away a long time ago. So if you own them all, you don't have to worry about any individual stock. The only thing you have to worry about is how much you're going to lose along the way. And one of the things I tell everybody, if you follow my advice, I absolutely guarantee, without question, that you will lose money. The question is how much, for how long, and what do you do about it if you're not comfortable losing that amount of money? Solve all those little problems, and pretty soon you've got a competent investor.
Paul, what's so incredible about everything that you just said is like that lines up exactly with my thought process. And for me, and maybe it's confirmation bias, but it makes me very excited about the strategy that I have chosen for myself and for my family over the next 20, 40, or 60 years. And I'm curious to really dive into the numbers just because I know that's something that you just have memorized on the back of your hand, right? I mean, you can pull this up without even having to think about it. If you look at like the market, right? And just for as a benchmark, let's just talk about the S&P 500. If you look at the S&P 500 over any significant duration of time, so I don't know if that for you would be 30 or 40 years, like what do those returns actually look like? The worst and the best?
The worst and the best. That's the right question to ask. I mean, that because we sell the best. I mean, that's Wall Street sells the best. And we need to understand the worst and the best. But what we know about the compound rate of return over the last 91 years, 9.7%. So that's a great return over a period of time that inflation was about 3%. That's important to know how much money they're taking away due to inflation. On the other hand, if we look at every 40-year period since 1928, what we find is the average 40-year period makes 10.9%. Now, that's a big jump from 9.7 to 10.9. Why that big jump? Because in that 1928, 29, 30, 31, 32, it was a bloodbath. And when you're looking at a whole bunch of 40-year periods, yeah, some of them have in 32, but a lot of them don't. And when you get rid of those horrible returns of that very tough economic period, it blossoms and makes a lot more. So if we look at the very best 40-year period for the S&P 500, it was 12.5%. If we look at the worst, and I love this, it was 8.9%. Well, okay, maybe you build your plan on getting the worst, but the worst theoretically shouldn't be any more than 8.9%. And the best is not likely to be much more than 12.5. But it also, and you mentioned when you're talking about the next 20 or 40 years of your life, Here's the problem we have. If an investor invested from 1975 to 1999, and this was about the time that John Bogle started his S&P 500 fund, from 75 to 99, the compound rate of return was over 17%. No wonder he became famous. He didn't have to even pick a stock. He didn't have to guess when to be in or out of the market. The market makes you money. Paul Merriman can't make you money. You guys can't make anybody money, but you can get people in the market and the market makes them money or not. But since 1999, from 2000 to 2018, it's less than a 6% compound rate of return. Some people, like myself, I'm 75. Boy, I'm a genius. I was there for the 75 to 99 period. So I look really smart. But if I had started in 2000, and if John Bogle had started his mutual fund in 2000 instead of 1976, I wouldn't have done so well. So we can do all the right things, believe all the right things, be patient, be disciplined, save lots of money, but the market doesn't hand us the premium we thought we were going to get, which is why another thing I try to teach people is prepare for the worst, but hope for the best. So that means if you need 10%, but you end up getting 8.9 because of luck or bad luck, then you have to have saved more. And that's the best defense we have against things we can't control, is saving more.
Yeah, Paul, and you're certainly speaking to kindred spirits here, right? In the FI community, we talk about savings rate being one of, if not the largest determinant of your ultimate success. And we have people who have 50, 60, 80% savings rates. So yeah, you're certainly speaking our language there. And I guess my question to you is, we're talking ultimately about increasing the odds of success and also understanding that people have, I don't know, maybe a behavioral gap or like psychological issues with the market. So I tend to skew towards simplicity, but and that's why I guess like the S&P 500 or VTSAX, that appeals to me. But if we're talking like increasing the likelihood of success, obviously you have investing strategies that you've become extremely famous for. And I'd love to hear your overview of that, this ultimate buy and hold strategy, and how it would help people. I mean, I guess, and what the high level is of like increasing the likelihood of success.
Well, I'll tell you what Bogle criticized me for when I sat in the meeting with him. He didn't argue with what I'm advocating for, and that is to expand the portfolio beyond the highest quality asset class, equity asset class. That would be the S&P 500. I'm advocating that you add some large cap value and some small cap value and some REITs, real estate investment trusts, and some international asset classes, including emerging markets. And you put these all together, and here's the magic of it. And it's not magic I created. It came out of the academic community. The magic is that the volatility as a group, all these different asset classes in little pieces, nothing gets more than 10% of the portfolio. And when you mix them all together, the volatility is virtually the same as the total market index or the S&P 500. But the return can be as much as 2% a year better. And I said a while ago that 0.5% is magic in changing our lifestyle later in life. So, to the extent that you can trust all of these asset classes, by the way, which you can't, because they're going to disappoint you. If you had all your money in the S&P 500 over that period of time that the market did so well, 75 to 99, yeah, you got a 17% compound rate of return, but doggone it, you weren't there when that happened. You just found out about it. You just started making enough money to be able to put some money away and start getting on the bandwagon. But guess what? From 2000 to 2009, even though the public predicted in several large surveys that the following 10 years that the market, the S&P 500, should make 20 to 30% a year for that decade. Instead of seeing a 20 or a 10, what really happened was a -1 a year for 10 years, something that had been magic for 25. So what do you do to protect against that? Because I wouldn't be surprised that somebody was disappointed when they get into this great asset class that everybody says is so hard to beat, that they give up and they say, "Oh, I'd just rather have a good bond, something that'll pay me a little bit, or at least I won't wake up tomorrow and have lost all my money," because so many people actually believe if they invest in the stock market, they could lose everything. Well, and you can if you don't do it right. But if during that 10-year period, you put some money in large and some in small and some in value and some in growth and some in U.S. and some in international, instead of losing 1% a year, you would have made about 7% a year. And you say, well, that's obvious. That's the winner. I'm going to do that for the rest of my life. But wait a minute. For the previous 3 years, if you looked at the return in the late 90s, 97, 98, and 99, I think it was, the return for this broadly diversified portfolio was about 4% a year instead of 20% a year. So there is no magic way. The best magic that I think people can create is to upfront decide what asset classes have a history of success. I didn't figure that out. The academics figured that out. And remember, they explained that better return came from taking more risk. This is not a free lunch. But you put together so many pieces in so many parts of the world that all that matters is what the market as a whole does, except now you're not just relegated to the group of stocks that are large growth companies, like you mentioned. If you look at the S&P 500, about 50 companies are driving that index. And those 50 companies are probably going to become very overpriced at some point. And when the market corrects, it's going to be something of a bloodbath for people who just didn't see it coming. I see this broadening of the diversification of asset classes. And of course, you got to make sure you buy them right, but that doing that is reducing the risk, not just the risk of the market going up and down, but that emotional challenge that we have that keeps us staying the course.
Paul, there's so many aspects to what you just talked about that I want to dive into a little bit further. The first one that I wanted to talk about is the value stocks, or as you described, the out of favor stocks. And I think that many people, rightly or not, have this perception that maybe this time it's different. Like, for instance, technology seems to be moving faster and faster. The rate of change seems to be faster and faster. And companies that had very, very stable business lines of business for years and years overnight become obsolete. And then maybe we could talk about gasoline versus solar. That's something that came up recently. Maybe you could talk about people's consumption of different types of foods, but these kind of blue chip stable companies suddenly don't have a buyer on the other end. And I guess the question is that a reasonable line of thought, or do you have anything to add to that line of thought that maybe would be helpful for someone that is a little bit leery of value stocks?
Well, I've been around in the business over 50 years. And as long as I've been in the business, there's been a catastrophe coming. And there's always list A, the good news, always list B, the bad news. And when the market's going up, people like to look at list A. When the market's going down, they say, well, look there, all that bad news. No, those two lists always exist. And when you own a portfolio that has, my own portfolio has over 12,000 stocks. So if I'm at a cocktail party and somebody brings up a company, I can probably say if I wanted to, oh, yeah, I've got some of that. That's a really good company. And I've also got some dogs. I know there are dogs. There have always been dogs. As a matter of fact, one of the most interesting studies of all that I have seen just came out in the last couple of years by a Dr. Bessembinder out of Arizona State University, I think. Here's what he did. He looked at every company going back to 1926, I believe. And by the way, the research had already been done in terms of getting together all of the price information and the information about dividends and all that. That's already been pulled out by lots of students who were helping to support these professors who've done this great academic work. And here's what Dr. Bessembinder found. He looked at every public company and how they did until they didn't. And then when they didn't, that was the end of their impact on the market. And some kept going and doing well or struggling, but those that stayed continued to be included in the group. Of all of the companies that were public in the US, 1 out of every 25 hit a home run. 1 out of 25. And it was that 1 out of 25 as a group, 4% of the companies account for most of the earnings of that famous 10% compound rate of return that we talk about getting from the stock market. And here's the killer. The other 96% on average made the same rate of return as treasury bills, as having money in a money market account, about 3% over that same period. Which means this has always been a problem. If I'm going to try to pick stocks, what happens if I don't get any of those 4% and get nothing but those in the other 96? I could have really bad returns. And that's true. But the beauty, and again, this is the academic community digging this out. This is why I have such confidence. And not that they can know the future. None of them can know the future. But understanding that, if I was trying to help somebody, I'd say, hey, you want to get the market rate of return, own them all. Own them all. Because that is going to give you the end result of the whole system. So if it turns out that a few companies are going to be the big winners, it's going to turn out to be just like the past. That's the way it's always been. And General Motors, by the way, when you look back at all the data, they're still number 11, even though they've failed in the last years and went into bankruptcy. They made so much way back when and paid out so much in dividends. They're still the 11th ranked winner in terms of producing return for investors, but not recently. The beauty of the index, owning them all, is you are guaranteed to own that 4%. And unfortunately, you're also guaranteed to own the other 96. What we don't know, and nobody does, is what return will all those people together produce. And if in fact they don't produce a very good return, it's very likely that we're going to have low inflation too. And if we have low inflation, you don't need a 10% return. You may only need a 7% return. So it's a whole bunch of moving forces, and the fewer moving parts we have, the more likely we are to succeed. Let our portfolios have 12,000 moving parts, but don't make me deal with 12,000 companies.
That's exactly it. And what I wanted to point out, and I want to talk really explicitly about the ultimate buy and hold portfolio. In my mind, one of the things that's crystal clear is that this doesn't deviate. This isn't different than the kind of the path that we've laid out of the advantages of index fund. Rather, it fixes maybe a perceived weakness of the way that maybe VTSAX is structured. You're making the case with the ultimate buy and hold portfolio that this path is not as diversified as it could be. And so to fix that, and please come through and fill in the gaps here, but to fix that, we're going to make sure that we don't just own a ton of the already really big companies and then a little bit of everything else, but you want to own 12,000 companies. You want to own everything, right?
Yes, yes. And there's a very important difference here between, for example, in most target date funds, which are my favorite funds by far for people who don't know what they're doing. But most target date funds are way, way overweighted to the large companies. And of course, that's what the S&P 500, as we discussed before, a tenth of the portfolio represents probably half of the value. Those are cap weighted. And in cap weighted indexes, the bigger companies are responsible for more of the return. What I'm advocating, and I'm certainly not the first to advocate this, is to build a portfolio that is made up of these great asset classes that I've listed before, and to give each one equal rights, equal exposure. So it's not cap weighted, it's asset class weighted. So I still got the S&P 500, but I'm not letting, and those 50 companies, by the way, but I'm not letting them drive the return because that asset class is built to pay a lower rate of return than small cap value and large cap value, et cetera. So that's the difference. It's asset class weighted versus cap weighted.
You very specifically mentioned that you didn't want to let the growth drive all the returns because you feel that over time, the return's already there. It's not going to be returning quite as much into the future if you look at the academic studies. And so what's interesting about that is I believe that is implicitly in that statement is that you are going to use a tactic like rebalancing. And just with my current strategy as I do it right now, I just throw as much money into, a VTSEX or an S&P 500 for as much as I can for as long as I can. But because I only have one fund, I don't rebalance, right? It's super simple. But this strategy with these different asset classes, that would require rebalancing. Am I correct about that?
Yes, that would, most people would want to rebalance, and most people may even have a slice of bonds in the portfolio that would require some rebalancing as well. Although, when you own that many different asset classes in the equity area, you don't actually have to rebalance, or you can use your new contributions to become the force of rebalancing.
You did an amazing interview. I just highly recommend it to anybody listening with Jim Dolly over at the White Coat Investor. And in that particular episode, you made the analogy of comparing, investing to dieting. You said dieting is something that you struggle with. I do too, Paul. I do too. But I wanted to bring back with dieting, one of the things that makes achieving a successful diet over time or making it a lifestyle is that every single time you walk to the fridge, you have to make a decision. At 3 times plus a day, you have to make the right choice and you need to pull that off, which is why over a period of a year, 5% of dieters are able to maintain that weight loss over any significant period. It was an amazing point and I got it. And you compared that to some degree with investing. My question or concern about this path, which just at an intellectual level, I love and I totally appreciate. But my concern is by adding this additional layers of complexity, which may better reflect reality, but adding this extra complexity, you're forcing yourself to have to make more decisions over a short, medium, and longer turn of time, which then puts more emphasis on the behavioral aspect of the investing process. And I'm curious, have you considered that? And what are your thoughts for the DIY investor?
Well, I love your comment because I almost think you were in the room with John Bogle when I was there, because that was basically what he said when he said I was making it too complex. And I left that meeting. It was literally life-changing for me, and came back and I called Chris Pedersen, who works with our foundation. I said, we got to figure out a way to make this simpler for people because I want people to have the premium for the risk of these other asset classes. But I'd like to figure out a way that it's almost as easy as owning a target date fund where they don't have to do anything or as little as possible, because you're absolutely right. The industry that feeds us is trying to get us to do things that are not in our best interest. The people who make cigarettes, they want us to smoke. And the same is true with Wall Street. If I start looking around for something to do and make more moves than are necessary, Wall Street's going to be right there. Come on over here, kid. I got something for you. And we got to figure out how to keep that from happening, which, of course, again, is why the target date fund is theoretically such an amazing product, because it keeps all hands off, including your own, and everything is taken care of for you. So, it's like dieting, except I do believe, because as I have said many times, and I just updated the number, I have now lost over 4,200 pounds in my lifetime. And I just put on 18 of them in the last couple of months. I mean, it's just so frustrating. But I have to every day go back to the table or to a restaurant, and they are so good at fleecing me for things that turn me on. And there is what Wall Street is oftentimes about. In the investing process, I'm going to make you rich. I'm going to show you how to get rich. Well, those things are appealing, and it's the same risk if we make it too complex and people give up. What do they give up and go do? Something bad for them? So I am dedicated, without question, to making this process simpler so that people can get the impact, particularly of small cap value. That's small cap value picks up small, and it picks up value all in one fund. So that's the real key to figuring out how to make this simpler.
Okay, so let's talk about the simple path to the ultimate buy and hold portfolio in 2019.
All right, you're getting me excited now. The path is this, and it's not going to give you all of the return, I don't think, of the complex strategy. But the bottom line is, if you get it done and you don't make quite as much, maybe that's better than having you wash out and not have a chance to make anything at all. So here's what you do. You buy, let's say you're a 20-year-old. You put your money into a target date fund. Now, target date funds are built to take care of everything inside in terms of how much you should have in stocks and how much you should have in bonds. And I have some huge complaints about them putting any bonds in your portfolio when you're 20, but some of them do it. But then I want you to multiply your age by 1.5. So if you're 20 years old, that means you got 30% to put into the target date fund. The balance will go into a small cap value fund. Now, if you're more conservative, you could use a large cap value fund. But then as you get older, you're going to continue each year to multiply your age by 1.5. So when you're 30, you're going to be 45% in the target date fund, the balance in small cap or large cap value. When you are 60 and you're getting close to retirement, then you would have 90% in the target date fund and 10% in small cap value. And you can see where this is going. It's acting just like a target date fund. It's winding down its exposure to the more productive, at least historically, more profitable asset class, and getting more exposure to both the bonds and the large cap growth class when you're in or close to retirement. So it is so simple. Now, you still have to be able to accept the risk of the market, because I can't eliminate the risk of the market when you're young, and that's what you should have exposure to.
Hey, Paul, I have two questions, and I'll ask them actually one at a time this time. So let's start with these target date funds. Are there good and bad target date funds? Are they generally made up of the same components? Can you talk me through what people should be looking for with good and bad target date funds, if there is that distinction?
You know, here's the beauty of target date funds. First of all, every one of us should have a glide path in our investment life. We should know how much risk we're willing to take now, and as we get older, how do we reduce that risk? And when we retire, how much risk should we have? That's called the glide path. And every target date fund has a glide path so that you can see right now at age 20 or 30, what will happen to your money if you put it in a particular target date fund. And you can look at Morningstar, their free site. You can go to the Vanguard 2060 fund, for example, and you go to the portfolio page, and you go to the bottom of the portfolio page, and there is the glide path right there, graphically, so easy to see what you're going to go through. So when I go to that Vanguard glide path, what do I see? I see 10% for a 20-year-old, 10% in bonds. Now, for every 10% in bonds that you have, it's going to reduce your long-term rate by about 0.5% a year. So that means that that 20-year-old is not making that 0.5% that they should be making, because the last thing they need in their portfolio at 20 is bonds. But that's how Vanguard does it. And that's something I talked at length with John Bogle about, but that's the way they do it. And I understand why, but they do. On the other hand, if you go to BlackRock, they don't have any bonds in the early years. So they have built theirs in a different way so that you don't get any bonds at BlackRock until you're about 40. So when I think about you guys doing your own thing, buying stock funds, I would say if you believed what these people believe, you wouldn't be adding any bonds until you're 40, because interestingly enough, at 40 is the same place that Vanguard starts increasing above that 10%. So they're 10% for the first 20 years, and then they start going up at the same place that BlackRock does. So there are differences. Certainly, I would not want to be in a target date fund that isn't built with index funds, because the index funds are going to give you more diversification and lower expenses. And so that's a key. And the low expenses, big deal. The lower the expenses, and I'm sure you guys preach this all the time, the lower the expenses, the better the likely return over the long run. Which means, by the way, when I'm recommending you have a small cap value or a large cap value, I want index funds, and I want low expenses, and I want massive diversification.
Yeah, Paul, that makes perfect sense. And that actually ties into my second question, which was about small cap value. So, I mean, clearly my big takeaway amongst many, but my biggest one is small cap value. And I'm going to look into this literally after we stop recording here. But I assume, unlike the S&P 500, which is fairly standard, right? There are these 500 companies. There are probably some differences amongst small cap value funds, right? And like, what should someone be looking for other than just Googling small cap value, Vanguard or Fidelity or whatever it may be? How would you counsel someone decide what to look for in a small cap value fund?
Well, we've tried to make this easy in terms of picking a small cap value ETF. This guy that I have so high regard for, this Chris Pedersen, he has created a best in class list of ETFs, so that and these are ETFs that you can get commission free at Vanguard. If people want to see what we would select, they're certainly willing to look at that. I'm not trying to be your personal investment advisor, but we're trying to help people through that last step. But you should know that some small cap value funds, or small cap funds as well, the small cap value funds, the average size company could be 1.8 billion, it could be 3 billion. Well, what we know historically is those that are smaller tend to produce better returns. And then we look at this. Remember, I talked about the relationship between the market price and the net worth, or the book value. And so you'll find that there's quite a difference in how deeply discounted the companies are in one particular fund versus another. So we've tried to eliminate some of that guesswork of funds that they can use. One of the things that's frustrating to me is we have analyzed over 100 401k plans. So somebody that works at IBM can go to our website, and there's my recommendations for the IBM 401k plan. The problem is most of the 401k plans do not have small cap value. They often have small cap blend. And by the way, small cap blend is okay as well, but you don't make as much because it includes growth and value as opposed to theoretically value only. So trying to find the right fund to go along with the target date fund, it's easy, by the way, with IRAs, because that you can control. But in your 401k, where most of your money is being saved, it's not as easy.
So, Paul, a confession here. I'm increasingly a huge fan of yours, and I've been enjoying diving into some of the portfolios that you have listed on your website, paulmerriman.com. I picked up an M1 Pi last year, and I ran side by side VTSAX or VTI, which is the fund that's available on M1, and an ultimate buy and hold portfolio. And obviously recency bias or whatever, but it got crushed by VTI. It just got crushed over the past 12 months it almost doubled. And I realized there's some individual factors there when money went in, et cetera, et cetera. My larger point is not what my experience was, because I get that this is a very small time frame and really doesn't count because we're looking at 20, 30, 40 years, what's giving you the best possible chance. But the larger point I wanted to make is, one, in your estimate, you wouldn't just create this more complicated process if you weren't getting some benefit. If the best option was just to do, VTSAX or VTI or whatever, yeah, let's just go for it. There has to be some perceived benefit. And then two, and this is the larger point, someone that's like, oh, I want to try this, but I want to try that because I don't know which one I really believe, so I'm going to run side by side. Like, I feel like the biggest danger is the person that fiddles, right? They try one, and then over 1 year, like, well, no, clearly the other thing's working, so I'm gonna go over here and do that. Like, you need to have some sort of anchor in order to stay the course on your chosen strategy. So thoughts on that, but then also, like, what sort of premium do you think you get for making your portfolio slightly more complicated?
Well, keep in mind that when we're thinking in terms of getting a premium, that we're talking about over long periods of time. And so 1 year, as we know, if we look 1 year at a time, small cap value is about 24% of the years going back to 1926 or 28. Small cap value is the number one asset class. When we go out to 40 years, it is number one in 94% of the 40-year periods. Small cap growth was never number one in a 40-year period and was number one in 12% of the 1 year periods. We have all these kinds of long-term studies. Now, Chris, he did the study, created a lookalike of the Vanguard target date fund all the way back to 1970. And then, based on a regular annual investment plus inflation, it grew to about 7.9 million over the average 40-year period that was tested. If you used the 1.5 times your age on small cap value, the average 40-year return was about 11.5 million. Now, keep in mind, you had a lot of value in the early years of that process because when you're 20, you've got 1.5 times the 20 is 30 in the target date fund and 70% in small cap value. But what if all you did was when you invested in the target date fund that you put another 10%, you put 90% in the target date fund and 10% in the small cap value. And you didn't want to let it grow to be too big, because if you're not careful, the small cap value can take over your portfolio. So what you did was you rebalanced on a regular basis back to that 90-10. The average 40-year return was over 20% more. Now, all you did was make a little bit, 10%, not a big deal. It didn't expose you to huge risk, and you rebalanced so that you never let it, get out of proportion with the rest of the portfolio. But if I can make somebody with these, I can't make, but if the market will make them an extra 20% and they retire with $2 million versus $1.8 million or $1.6 million or something, that's worth the effort. As long as you understand and don't panic along the way, because there'll be lots of time that stocks underperform bonds, that small underperforms large, and that value underperforms growth. That's the nature of the market. It's not a straight line from point A to point B.
Yes, and thank you so much. And obviously, I'm throwing out a false flag there with my tiny little 12-month investing horizon. But I really wanted to get to the heart of those numbers. And Paul, we are blown away and so thrilled that you came on the show and shared your insight and perspective with us. And while on most shows that would be the end of the episode, on this show we would love to give you the chance to tackle the hot seat. Are you ready for this?
I am. I can tell you. I mean, this is strange for an old guy who doesn't get upset by very much, but I got a little anxiety about this.
Us crazy millennials in our hot seats. Let's do it.
In a world drowning in debt and rampant consumption, trapped by the chains of lifestyle inflation, these questions highlight the secrets of those who have broken free. Welcome to the Choose FI Hot Seat.
All right, Paul, question number 1, your favorite blog that's not your own.
Well, I think, and this guy is almost unknown. He's written a column from time to time at MarketWatch, but it's the OnCourseFP.com site, George Sisti. This is a retired United Airlines pilot. He is one of the smartest and most common sense investors that I've ever known. A terrific teacher. By the way, he's also an investment advisor who has 30 clients and doesn't want any more. He's retired, but his blog, I just think, is one of the best in the business.
Awesome. Well, we will 100% check it out personally and link to it in the show notes for today's episode. Question number 2, your favorite article of all time. Now, this can be one that you wrote or someone else's.
Well, of all the work that I've done in terms of changing people's financial lives, we've talked a lot about it, but it is my favorite. That's the ultimate buy and hold strategy. And of course, now that we've added the 2 funds for life, I have to mention that right along with it. But the ultimate buy and hold strategy has had well over 500,000 opens. So it is something that people are finding useful.
Fantastic.
All right, Paul, question number 3, and this might be the anxiety-inducing one, is your favorite life hack.
Well, I didn't even know what a life hack was.
I had to Google it.
Yes, exactly. By the way, I loved looking at some of the list of my favorite 100 life hacks. So I've learned a lot in that process. But you know what I am? I'm an old timer who makes a to-do list every day.
Oh, what you really are is a kindred spirit with Brad Barrett.
Are important to get done today. 5 items that aren't important but are easy, and I make a new one every day, and it drives me.
That is very cool. Yeah, it's funny, Paul, because that actually was my number 1 life hack as well. Is I use an app called Todoist. It's a website, Todoist.com, and yeah, I basically offloaded my entire brain into this app. So like anytime I have any recurring task, even if it's something like renew my passport 5 years from now, it's literally in there. So I never have to think about any of these items again. It has transformed my entire life.
What is it again?
Yeah, it's Todoist. So Todoist. And it's marvelous.
Wonderful.
This episode brought to you by Todoist, friend of the Barrett family. All right, guys. Question number 4, your biggest financial mistake.
Well, my problem has been that I'm afraid. I've always been afraid of a catastrophic event right around the corner. I mentioned earlier the list of A and B, the good news and the bad news. I've always gravitated, unfortunately, to the bad news. And so I really was way more conservative as an investor than I should have been. And I know now that if I use a more mechanical investment strategy, that the probability of success goes way up.
Yeah, and Paul, I think that makes you human, right? We're all subject to loss aversion. I mean, losses hurt much more than gains feel good. So yeah, I mean, anything to take your brain out of this. I think that's kind of informed a lot of the questions we tried to ask you today. We understand psychology gets in the way, even for someone like you, right? How can you make this something that is simple for people? So yeah, I mean, certainly I appreciate that answer and your advice throughout this whole episode.
All right, question number 5, the advice you would give your younger self.
Well, I guess it would be one to ignore the noise. There's so much noise in this process. I think if Jason Zweig's book, Your Money and Your Brain, was around, I would absolutely call that required reading as a young investor, because it does address the psychological end of this process. And as an advisor, I found that most people around money topics are a little bit nuts. And that book explains why we are nuts. So definitely, and I think I, like everybody else when I was young, thought I could beat the market, that I'd have more money today if I hadn't believed that and believed others when they said, we can help you beat the market.
All right, Paul, we have one bonus question for you. So in the FI community, we talk a lot about cutting expenses and cutting out kind of needless waste in our lives. But that said, purchases bring value. What was the purchase you've made in, let's say, the last 12 months or so that has added the most value to your life?
Well, at my age and with all that I have, it is very difficult for me to get something new that I get a sense of, wow, this is wonderful. And this is going to be silly to you guys. But when I talked to Zach, and Zach said, you need to get a better mic. By the way, the mic he recommended is only $62. And I think I paid $100 for the Apple one that he said isn't as good. And I thought, God, I don't want to spend $62, but all right. I took his advice, and it's been the best purchase I've made in the last year.
Wow. That's
thanks
awesome.
to Zach. Thanks to Zach. And I think maybe you guys told him to tell me.
Well, I didn't know we were going to get called on it. But Paul,
I don't mind. I can learn.
Paul, your audio quality has been amazing. And even more than that, the information and the generosity of spirit you brought with the episode has been even more. So thank you so much for being willing to come on the show and share your story with us.
And by the way, guys, keep up the good work. I just think the work that you're doing is fantastic. It's necessary, and it is life-changing.
Paul, you have a nonprofit that you founded when you officially retired. You made the pact to your wife that you would never do work for $1 again. Tell our community, what is the best way that they can connect with you, connect with your nonprofit, and connect with your content?
You know, they can go to paulmerriman.com, and my email address is paul@paulmerriman.com. I try to answer every question, but I don't get to them all. Some I'll do on a podcast or in my newsletter, but almost everything on the site is free. I hope people will come and take advantage of me.
Brad, I cannot wait to do our roundup on this episode. There was so much here. And in my mind, this is not a rebuke of the simple path to wealth. Rather, this highlights the power of that approach and fills in the gaps on a few other areas.
Yeah, you're absolutely right, Jonathan. And this certainly was the furthest thing from a rebuke, right? I mean, this was really exactly in line with our thinking with VTSAX. Just, I guess Paul would augment it. And there's nothing wrong with that. It's just a slightly different strategy. And after hearing him talk about small cap value being the real driver for a lot of the potential gains here over many decades, it's interesting to me. It's something that I'm going to look into. I cannot promise that I'm going to change my investing strategy going forward, but anytime I get new information, I want to research it and I want to look into it. And this one episode did that for me. So just in and of itself, that was a huge takeaway for me. And I suspect the audience is going to get a lot of significant takeaways from this.
If you got value from today's episode, and if you've been getting value from the episodes up to this point, just take 1 second and press the subscribe button on the platform you're listening to this on. Just lets the provider know you're getting value from the show and you want to be here when we produce additional content. If you want to support us in what we're doing here at Choose FI, here are 4 easy ways. 1, leave us an iTunes review. To do that, just go to choosefi.com/iTunes. 2, use our page to sign up for travel credit cards. If you want to travel the world with miles and points instead of your hard-earned dollars, then just go to choosefi.com/cards and get started today. 3, if you're working on the milestones of FI, set up a personal capital account to track your progress and use our affiliate link. It's completely free, and just go to choosefi.com/PC. P as in Paul, C as in cat. And 4, and most importantly, find your friends, coworkers, and family members who might be open to this message and tell them about the podcast. Have them start with episode 100. It is a fantastic starting place. All right, my friends, the fire is spreading. We'll see you next time as we continue to go down the road less traveled.
You've been listening to Choose FI Radio Podcast, where we help middle-class America build wealth, one life hack at a time.